Well, good afternoon, everyone. Hopefully, we'll start right on time today at noon. I just wanted to introduce myself. My name is Joseph Marshall, and I'm an intern with the Washington Department of Veterans Affairs. I'd like to thank you all for joining us today for our Lunch and Learn. And I'd like to welcome back our guest speaker for today, Nathan Spieker, the Financial Education and Outreach Coordinator at the Washington Department of Financial Institutions, where he works to promote financial capabilities among Washington residents. In his work, Nathan has had the chance to travel Washington State and learn about the financial challenges and the success stories in our communities. Nathan will be sharing some interesting information with us today related to financial wellness, specifically investing. So without further ado, I will turn it over to Nathan. Welcome.
Thank you so much, Joseph, for the introduction, and thank you all for being here today. I will share my screen here. Hopefully you all can see this. Today's topic is a brief introduction to investing. There is a lot of knowledge out there around investing. I'm sure many of us already have a pretty good grasp on the fundamentals of investing. So maybe for some of us, this will be recap, and for other of us, it may be new information. As Joseph mentioned, my name is Nathan Spieker. I'm the outreach coordinator here at DFI, Department of Financial Institutions. So who are we? Department of Financial Institutions, we do four things. We license, regulate, promote financial education, and protect Washington residents as they navigate the financial marketplace. We're a state agency, and we provide regulatory oversight for Washington's financial service providers. So that includes banks and credit unions. It also includes financial advisors, investment advisors, payday lenders, personal lenders, money transmitters, really anybody sort of who works with money and makes money off of moving money or working with money is how I put it very, very simply. So our website is dfi.wa.gov. And we've got a lot of information on our website regarding financial education. You can also verify licenses and file complaints about financial service providers. So feel free to check that out. Quick disclaimer, as always, the comments and opinions expressed today are solely my comments and my opinions and don't necessarily reflect those of the Department of Financial Institutions, its management, or anyone associated with DFI. Additionally, we cannot give legal or financial advice, and we do not endorse or recommend any person, product, or institution. So what I'll be sharing in today's presentation will be mainly sort of best practices and fundamentals. I won't really be able to go into detail about specific actions that we might want to take regarding investing, or specific companies we may or may not want to invest in. That is outside of my scope, and it is also not. Yeah, I mean, I just can't really talk about that. I don't want you all to have a bad experience because I say something that's not quite right. I also want to maintain the integrity of DFI as an impartial entity. Okay, so first things first, what is investing? Investing is the purchase of assets with the goal of increasing future income, right? So we buy something now, and we hope that later on we'll be able to sell it for more than what we bought it for, right? The focus is on accumulating wealth, and it is generally appropriate for long-term goals. Long-term goals, there are many sort of long-term goals that can be achieved through investing. A couple examples are saving for our retirement, saving for the next generation's education, among many other things, right? But generally, it is best for long-term goals, right? So a quick look at how much we're saving We saw during the pandemic, and these are statistics from the St. Louis uh, Federal Reserve Bank. We saw during the pandemic there were some spikes in personal savings rates. However, they have sort of dropped off after the pandemic as cost of living has increased quite significantly for the vast majority of us. And as such, with cost of living increasing, that means that generally we have less money available to put into savings. However, those savings need to stretch further than ever. Life expectancy here in Washington is on average about a little over 79 years. So that means that after retirement at 65 or 67 or whenever we're able to retire, we need to plan for at least another 10 to 15 years in many cases of living on what we've saved up and what we've invested for our retirement, right? And then another aspect with aging is that oftentimes our health care related expenses go up as well. So even though we may live very frugally, there are other things that are sort of outside of our direct control, such as health, that may come up and play a significant role in how far our money goes once we do hit retirement. So to get a closer look at your reality, you can think about your family members' lifespans, your current and your future health situation. And that may inform us as to how much we should be saving, how long we can hopefully expect to live, and of course, how long this money will have to last us, right? Also, I just want to say if there are any questions throughout the duration of the presentation, please feel free to put them in the chat. I won't be able to monitor the chat super intensively at this moment, but towards the end of the presentation, we also do have a slide for questions where I'll try to go back through the chat and answer anything that has come up. Okay. So some experts say that we need about 80% of our current income for every year in retirement. And of course, that may not account for significant increases in healthcare costs. CNBC in January of 2024 said that in Washington state, the average annual retirement expenditures were just short of 67,000 years, right? So the minimum we would need for 25 years of retirement would be 1.1 million. If we plan on living very long, we would need a little bit more than that at around 1.3 million. So that is a lot of money. And we will probably be pretty hard pressed to put away that amount of money if we just put it into a savings account, right, with relatively menial rates of interest, rates of return, right? So that is where investment sort of comes into the picture. Okay. So we're going to talk about the time value of money. This is the idea that money available at the present time is worth more than this same amount in the future due to its potential earning capacity. If I, having been a third grade genius, I would have bought a house in 2008, right? And after the crash, right? I would have probably wanted to scoop one up when it was pretty cheap, and then I could have sold it now for quite the profit, right? If I had also been a genius, I may have invested in stock in some successful companies back in the day and then be able to sell that today, right? So those $100, let's say, that I could have invested 10, 15 years ago would be worth significantly more than the same $100 today because of their potential earning capacity. And another aspect that factors into the time value of money is inflation. This is the risk that the general level of prices increase, right? And we are all very familiar with inflation. We've experienced it greatly over the past 4 or 5 years now. It's once again the danger that money won't be worth as much in the future. I don't know about you all, but when I was a kid, if I got $100 for my birthday, I felt like a millionaire. Nowadays, $100 will barely buy me a couple, 2, 3 bags of groceries, right, at the grocery store. So that money is buying me less goods and less resources now than it did in the past, right? So, um, the time value of money, I guess, in addition to the potential growth of the money that can be invested, it also hedges our bets against inflation, right? So it sort of serves that dual purpose there. There is what's called the rule of 72, and the operating question here is how many years will it take for an investment to double? And the calculation to figure this out is that the number of years that it takes for our investment to double is 72 divided by the annual interest rate. So if we, well, let's see, I'll pull up a calculator and try to figure something out right now. If we get a 4% interest rate on a high yield savings account, which is pretty attractive, we would do 72 divided by 0.04, right, which is that 4% expressed as a decimal. And that means, is that right? Maybe. Maybe. It says, no, I don't think so. Actually, I think it's 72 divided by just 4%, right? And that says it'll take 18 years for my investment to double if I get a 4% rate return. Um, So that's something to keep in mind as we're investing. Historically, it seems like the stock market has given returns of around 6%. So if we do 72 divided by 6, that brings it down to 12 years. So we can expect with the historical rate of return of the stock market that in 12 years, the money that we invest will double, right? Okay. There are plenty of other time value of money calculations available. There's a resource here, bankrate.com/calculators, where we can look at a variety of different calculators to figure out how we can sort of expect our money to grow in the long term. So another thing to consider is the importance of interest rates when we are investing. The value of $1,000 invested at different interest rates is shown in this graph. At 4%, $1,000 will be worth $2,191 in 20 years, and in 40 years, it will be $2,801. Now, this is using compounding interest. But now if we go just one down from 4% up to 5%, we see that after 40 years, the value of those $1,000 goes up to $7,000. So that's not quite a 50% increase in the future value, but it's close to it. So we may say, well, 1%, it doesn't make that big of a difference, right? Well, in the short term, that may be true, but as we're thinking in the long term, it does make quite the difference. And of course, the same is the case with any sort of debt or loans that we take out. A 1% difference can make a tremendous amount of impact. It can have a tremendous impact on how much we end up paying in interest and for the loan over time, especially if we're talking about something as expensive as a house and with a term as long as a traditional mortgage loan, which is about 30 years, right? 1% interest can be tens of thousands, if not hundreds of thousands of dollars of difference paid in interest over the course of that home loan. All right, so let's look at a couple examples of the power of time. So in this case, we've got Martha. She has contributed $2,000 a year from age 25 to age 33. The total contributions were $20,000. And with this 9% interest compounded monthly, we see that at the end of those 10 years of investing, her $20,000 grew to just short of $29,000. Once she hit that point, she stopped investing entirely, right? And she just let it sit there until retirement. Next, we have Bob. same sort of situation, 9% interest compounded monthly. Now, Bob didn't start investing until age 35. And once again, he put $2,000 in investments every year and contributed to his retirement account from age 35 to age 65. So a total of 30 years of investing. His total contributions were 62,000, and by the time he retired at 65, his investments were worth 352,000. Now, if we compare the two, you may be surprised to realize that Martha's net value at retirement was actually higher than Bob's. And there are a couple factors that come into play. First of all, it's important to note that Martha invested for 10 years and she stopped investing after that, or stopped contributing more to her investment account after that, and just let it sit there, earning that same 9% compounded monthly until age 65. Her net value at retirement was 545,000, whereas Bob's was 352,000. That's over a $300,000 difference, despite having invested just a third of what Bob had invested. So, what does this tell us? It tells us that time in the market beats timing the market, right? So the earlier we can get into investing, the better, because we give that money more time to grow, right? So even though Bob contributed more because he got into the game 10 years later, his investments lost 10 years worth of growth, right? And as we're going to see later on in the presentation, oftentimes when we start investing when we're young, the way that our investments are allocated tend to be a little bit more aggressive, just because we have more time to make up any potential losses. And as we age, the investments tend to get more conservative because, once again, we have less time to make up big losses, right? The value of time in the market. So I found this really interesting. This is the sources from Bank of America's S&P 500 returns from March of 2021. If an investor tried to time the market and miss the best performing days over the last century, they would have earned just a fraction of the total returns. Staying invested over the entire century led to over 17,000% returns, yet missing the 10 best days over each decade led to returns of just 28%. So here we can see, broken down sort of by the decade, we can see that the 1990s was an incredibly profitable decade, 316% return over the course of the decade. If we exclude the 10 best days in that decade, that number is cut in almost half, right? In the 1980s, the same is the case. In the 2000s, we experienced quite the financial recession. So the overall return on investment in the 2000s for the S&P 500 was a negative 24%, whereas if we had missed out on the 10 best days, it would be a negative 62%. Sorry. So once again, time in the market beats timing the market. We want to try to stay invested because in all likelihood, we are probably not investing savants, investing geniuses, and leaving our money in there allows it to sort of recover and not miss those best days, best performing days in the market. We certainly do not have to be a genius to be successful in investing. Warren Buffett says success in investing doesn't correlate with IQ. Once you have ordinary intelligence, what you need is the temperament to control the urges that get other people into trouble in investing. Yeah, I think that's a good point to take into consideration. So a few concepts on psychology and investing wisely. I'm going to go through these fairly quickly. We've got overconfidence, which means that we think we know better than the market, right? Oftentimes that can be sort of a blind spot, right? We've got loss aversion when we focus on one stock or one investment that is losing money, and we hope that we will eventually regain uh, the money that we invested in it. Anchoring, once again, is holding on, oh, my apologies, holding on to one stock that we've invested in. Um, okay, well, I see we're at 12:20, so I'm just gonna skip ahead a couple slides because we have a little bit more to go through. So the best time to invest is now, right? It may be wise to refocus goals from saving to investing, provided we do have a sufficient um, sort of financial safety net, let's say. And it is important to overcome the procrastination of getting into investing. Um, we may not get to this slide later just because of time restraints, so I'll mention it now. Being Washington State employees, we've got the Department of Retirement Services that offers investing options for us, basically free of charge, right? We've got the PERS plans, and then we also have the deferred compensation program, which is sort of a more similar to a traditional investing account. So 5 keys to success here are making investing a habit, setting exciting goals, because those goals will be the motivation for us when we think about making these financial decisions, right? Number 3 is not taking unnecessary risks. And it is important to mention that all investing does carry risk. So a couple things to keep in mind are keeping time on our side. That factors in with that unnecessary risk. And of course, diversifying our investment is another very important part in minimizing our risk as we invest. So portfolio diversification reduces the risk we take on by spreading our investment money among a wide array of investment tools. We've all heard the saying, don't put all your eggs in one basket. I would probably add to that, don't put all your money in one stock, because then you're very dependent on that one company doing well to see returns, right? And few of us can look into the future and tell what's going to happen. So it is generally best practice to diversify the money that we have invested. And give me 1 second as okay, let's see. So the risk return trade-offs, obviously the more risk we are willing to take, the greater the potential return. But once again, the more risk we're willing to take, the greater the potential loss could be as well, right? It sort of works both ways. There are all sorts of different investment tools. There are stocks, bonds, mutual funds, real estate, and speculative investments. And there are different sort of philosophies we can take towards investment as well to match up with our tolerance level and the amount of risk we're willing to take. So there's this investing pyramid here where we see as we go up the pyramid, the risk increases and the liquidity reduces. So that means our ability to turn that asset into money, into cash, basically. And then, of course, as we go down, the liquidity increases. So it's easier to turn that investment into real money. But of course, the risk reduces, and generally, the gains we'll see as a result of that investment do reduce as well. So we see high risks. Sorry, what's that? Okay. We see high risk stocks and business ventures at the top of the pyramid. Those have um, high risk. We could potentially lose a lot. We could potentially earn a lot, right? For growth and diversification, we've got securities, corporate bonds, and paying down our mortgage. For savings and accumulations, we've got treasury notes and bonds, got mutual funds and homeownership. And then, of course, for protection, we've got emergency savings, wills, and trusts. So depending on our sort of risk tolerance, we may choose to invest in different ways. And this graphic here shows different ways that people invest based on their risk tolerance. For aggressive growth, we see a high percentage of that is in US stock. For more conservative growth, or for more conservative risk tolerance, rather, we see a high level of investment in bonds, which are generally a little bit more secure. And then, as I mentioned earlier, when we do invest into retirement accounts, many times those will be the money we invest will be allocated to target date retirement funds, which is basically they set the target date for your retirement based on your age. And as you get older, the type of investments that they engage in gets increasingly more conservative. So from the 20s to the 30s, a large portion of the investments are in stocks. And then as we get older, a larger proportion ends up in bonds and in money market accounts as well, right? Once again, the reason for this is because we don't have as much time to make up potential losses when we are, say, 55 and we want to retire in 10 or 15 years, as we do when we're 25 and we still have another 40 years to go. So I'm glad we did get to this. There is deferred comp in Washington State. So we as individuals contribute either pre-tax or post-tax with the new Roth option towards this plan with regular paycheck deductions. It gets deducted automatically from our paycheck. We can make choices as to the investments under the plan. And we can also select either a percentage of our paycheck or a specific dollar amount, starting with as little as $30 per paycheck. So the DCP is a Section 457 plan administered by the Washington State Department of Retirement Systems, and it's fairly similar to a 403B program, right? So it is a managed sort of investment opportunity that we can take advantage of being state employees. There is potential for fraud in investments, and that is why it is really important to protect yourself as you think about making investments. It's important to research the person selling investments, make sure that they are licensed with DFI. You can verify license with DFI on our website, or you can also call us at 1-877-RING-DFI. Additionally, we want to research the investment is itself. We want to make sure the investment is registered with DFI. We want to read the prospectus carefully, which is a document that basically gives us a lot of introductory information as to the nature of the investment and what we can expect. And if possible, it's a good idea to interview other investors as well to sort of see what their experience has been with this investment. We've all heard it said, if it sounds too good to be true, it probably is. So be very careful. I know we all work very hard for our financial stability, and the last thing I want for any of us is for us to get caught up in some fraudulent investment and lose out on that financial wellness and stability. So I cannot believe it, but actually I made it through this presentation in the 30 minutes, which is spectacular. Feel free to contact me. My email and phone number is here on the slide. And if you wouldn't mind taking this voluntary audience survey, that just lets us know how we're doing, what sort of feedback you can give us. We're always looking to improve our presentations, and getting feedback from the people we present to is an important part of that. So I'll take some questions now. Let's see if I can pull this up here. Let's see. Are there more in-depth classes you offer? Regarding investment, since this was just a half-hour session, traditionally I do have a lot more slides sort of talking about stocks, mutual funds, bonds, and explaining what each of those are, as well as their risks and potential benefits. But just because of the time restraints we had today, I decided to sort of put that aside for the time being. We do also provide financial education presentations on budgeting, credit, fraud prevention, saving, a whole host of financial education topics related to personal finance specifically. Somebody asked, can I increase contribution to PERS too? I don't believe so. I think that is uh, a fixed level of investment, a fixed deduction they take from your paycheck. But if you are interested in investing more, you could always look at the DCP program, which is also offered by um, the Department of Retirement Systems, and they do offer an option for you to increase your investments periodically. Any other questions at this moment? How do we take more in-depth classes? How to sign up? So we do, we've been partnering with the Department of Labor and Industries for their lunch and learns. They've opened it up to statewide employees. So if you are interested in that, please contact the Labor and Industries Communications team to get in touch in terms of that. We also do offer presentations to organizations, schools, any sort of civic organization or any group, even if it's a knitting club or a reading club. We just ask that there be 5 or more people there just to sort of make it worth the resources that we spend to make that happen. And you can request a presentation on our website, dfi.wa.gov. Does the
Well,
department do any youth outreach programs on personal finances? Yes, we do. We have gone to high schools and middle schools before to do that. We also work closely with some of our counterparts in OSPI. They have the Financial Education Public-Private Partnership, which works in training teachers specifically on how to teach financial education. Oh, yes, I can absolutely put the survey link in the chat. Give me 1 second while I find that. I should have this.
well, Nathan, I'd like to thank you so much for the presentation today. We've had a lot of questions in the chat, as well as kind of back early on with the presentation, and we've had multiple personnel involved actually helping answer some of the questions as we've continued. I know we've kind of just gone a few minutes over time, but I'd like to thank you and everyone for so much for the information being shared today, as well as being involved. I know personally that I have some more work to do on investments as well as financial wellness. So I just wanted to thank everyone so much for everything today. And Nate, I'd like to turn back over to you if you had any final comments or anything you'd like to share kind of before closing out today.
Yeah, I'd just encourage you all to look into investing. It's never too late to get started. I mean, of course, it's always going to be the case that yesterday was probably the best time to start investing, right? But today is a better time than tomorrow, right? I also want to mention that I did drop the survey link into the chat. And thank you all so much for opening up this space to me. Thank you for your attentiveness and for your questions as well. Yeah, feel free to contact me if you have any further questions as well. Yeah, thank you.
All right, thanks everyone. We'll end the presentation at this time. I think there might still be some comments happening in the chat, but we'll stop the recording at this time.